All right. Welcome, everyone, to our webinar on roaring success. Wait, actually, no, that's not what this webinar is about. This webinar is about when things don't exactly go as planned, which pretty much happens 100% of the time anybody works on a startup. But at some point, as I quoted today on LinkedIn, Josh Koppelman told me once that sometimes as an investor, you have to switch from company advice to career advice. And, you're starting to talk about alternative plans for someone's future and the company's future and when those things might separate. And so we're going to talk a little bit about investor roles and also some of the legal requirements as well and some of the process issues. So, Gray, why don't you start off by introducing yourself and we'll go around.
Absolutely. Absolutely. And thank you so much for hosting, Charlie. It's wonderful to be joining today. So my name is Gray. I work at a company called Sunset. Sunset has the unique privilege of helping other startups wind down their operations. So we have been in business now for a little over 2 years, helped well over 500 venture-backed startups navigate end of life, spoken to countless hundreds more, and helped connect them with the right resources for their situations. But yeah, I am one of the dissolution consultants. I meet with all of the founders that come and explore Sunset's platform and services, and generally here to help find a solution, help scope a solution when companies are thinking about winding down. So really happy to be participating.
Thanks. Hey, I'm Heather Miles. I'm a partner at Goodwin, and I work with emerging companies and with their investors. This is, I think, a very important webinar. I think it's important to normalize the process of winding down and when companies don't go as planned. And I also am really empathetic to folks who are in this situation because it's an incredibly hard time for founders. So I think it's great that Charlie's brought this group together to offer support when folks are going through this process.
Hi, everyone. My name is Geri
Cool.
Kirilova.
And Geri.
Clearly, I'm in the webinar about things that go wrong. So if the internet stays a bit more stable, I'm a partner at Laconia. Laconia is a New York City-based pre-seed and seed firm. We invest in mission-critical technology startups, tends to be a lot of B2B, SaaS, healthcare, fintech, e-commerce enablement, retail tech, prop tech, and all different types of vertical software. Excited to be here and to talk about the good, the bad, and the ugly.
Cool. So, Geri, I'm going to start off with you. What do you think, in your experience, founders are understandably feeling when they we lost Geri. Okay. I'm going to direct that question to Gray because you guys are dealing with a lot of founders who are nearing this process. What are you hearing from them? And Heather, I'd like your take as well as to what are the feelings that are coming up during this period of time? And why is it important to just make this sort of a normal process?
It's a great question. And I'd say by the time founders come and speak to us, candidly, we see a myriad of different emotions, but the most common are very reasonably a decent amount of shame, a lot of stress, a lot of anxiety. When I say shame, I often think about the fact that, all great founders start out on their mission with a sometimes potentially delusional belief that their baby and their business is going to pan out. And through sometimes no fault of their own, market condition shifts, execution shifts, execution doesn't happen as they expect it to. And they get to a place where they realize their dream is not going to pan out. And, they tend to have a ton of shame. And I think the reaction to those emotions and how it dictates how they then choose to proceed makes all the difference in terms of where their career can go from this moment. And I can kind of double click on that in a moment. But I would say most common that we see is just a lot of shame, a lot of guilt, a lot of feelings of disappointing other people, be it their employees, their investors, themselves. So I think, any work that we can do to normalize this experience and, kind of position it as unfortunately, based on the odds of early stage startups, a very likely outcome for a lot of folks and destigmatize it, I think it would do wonders for the whole entrepreneurship ecosystem.
Geri, what are you sensing?
From what they've
entrepreneurs are
shared with
going
us,
through
I think a
emotionally
lot of
during
it
this period
is
of time?
a fear of disappointment. I think there's some amount of fear of what they're going to do next and whether they're employable after having done this for 7, 8 years in some cases. We actually recently hosted an event. It was actually the 10-year anniversary of Laconia. And one of the founders who we had backed maybe 7 or 8 years ago, who we hadn't heard from in maybe 2 or 3 years after the company was sold, he showed up and we were like, oh my God, we're so excited to see you. What's going on? Can we catch up on the last 4 or 5 years of life or however long it's been? And he was like, after we sold the company, I just felt like so embarrassed and I felt like nobody wanted to talk to me anymore. And we were just so kind of shell shocked by that. We had just kind of figured he was dealing with the acquisition, integration, busy life, all the things that happen.
Oh, Jerry's having some issues.
But, it
I'll
certainly
actually add to
certainly
that.
wasn't our.
I'm thinking of one particular founder who ran a company, raised an A and a B, ran into some difficulty at that time, did a deal with a private equity firm that turned out to be kind of a bad actor, to be honest, and got pushed out of the company. Um, and ultimately the company was sort of went off the rails, kind of sold for scrap, no return. But I thought she did a terrific job, and I went to go back her again. And what was really surprising, actually, is she had never kept in touch with any of the original investors. And so there were a whole bunch of people that had backed her first company that didn't even know that the company didn't exist anymore because she was embarrassed to talk to them about it, even though many people thought that while she was there, she was doing sort of a terrific job. And it actually just, even that lack of communication around bad news impacted her fundraising the next time around, because there were all these folks who just like hadn't heard from her in a while, which is like happens more often than not. Heather, from your perspective, sort of what are there any other feelings sort of going on during this period of time? You're coaching and counseling people from the legal side through this.
Yeah, I think over many, many years and seeing lots of companies, I think that what Gray and Jerry have said, and you said, Charlie, is really true. It's a wide range of emotions. And I can tell you that like the folks that should feel shame because they've actually done something improper typically don't. And everybody else who's feeling shame should not be disappointed in themselves. In my experience, you have done your best, and it's a really tough process. It doesn't make me look differently at you when I'm talking about potentially working together in the future. And I think the same as we've heard from other investors. And I think that eventually, hopefully, there's a relief at the end of the process. And to me, it reminds me of striking the set in like a play in high school or college. And it's really important to go through that process because you built something. And even if it's the end and it's coming apart, it comes apart piece by piece, and it really does help the founder emotionally process it. And it's also what you need to do from a fiduciary perspective.
So I actually just want to hone in on one thing that you said before we talk about the pieces of the set, and I turn it over to Gray for that. You said that the folks who aren't doing what they should versus that they are. And as a founder and really investors around the table, what is that bar for, like, I've done things on the up and up, right? Like I did everything I could. And that doesn't mean maxing out all your personal credit cards and, going to the blood bank or, pricing a kidney or whatever.
Loaning against your 401k, which I really would recommend not doing.
Yeah. All of the above. Is there a short list of boxes that, let's start from the founder perspective, that you check to say, like, hey, I should feel okay about what I've done here, just from a basic legal perspective? Because I want people to understand that, like, the bar is not nearly as high as a lot of founders make it out.
Sure. I mean, I think for founders, it's a mix of legal and for, the vast majority of founders, which are all good actors and great humans willing to do something adventurous. I think that for most of them, it's both moral in addition to being legal. Thankfully, I think those two things align here. I think folks want to see right by their team, always the great founders. And I think it's important from a liability perspective, obviously, to see right by your team. And it's also something that even if some dollars are going out and don't return in the waterfall, I've really never heard pushback from around the table because it just makes good sense, for the ecosystem as an investor, again, to even limit liabilities, to have somebody sign a release and get some severance if it's available. I think that's a really big, it also, wage and hour is really important because if it's not paid, what is owed, not necessarily extra severance, but if things that wages aren't owed, there can be personal liability for officers and directors, and in some states, including New York, even the largest stockholders. that's something that's like really bad and you don't want to get to the end of the line on, because it will come out of people's pockets, including potentially even some of the senior investors around the table. I think founders aren't going to take the low bar because it's just not how they're wired. So I recommend that people actually like figure out what they're not willing to do. Like, don't get divorced over this. You know what I mean? Like seriously, I'm actually like not joking about that. Don't bet your kids' tuition on this. Don't bet your down payment on your house on this. Don't max out your credit cards if you're not willing to. Sometimes founders max out their credit cards and then they know they can pay them off over time. Things like loaning on your 401k, I've seen folks do that can get really hairy because of the tax implications. And no, usual suspect grade A, B, C wants to see you do that. So I think it's really important to have boundaries. What do you need to do? I think process is legally so important, and also records, because you want to document that process. Even though the bar is pretty low generally, you want to assume that there could be revisionism down the road or liabilities could pop up. So you want to assume kind of an enhanced scrutiny of the process, and that it'll be looked at from a higher bar. I don't know if anybody else has stuff to add on this point, because I think it's interesting to hear about what you think founders should be doing or kind of want to do in this process.
Geri, what do you want out of founders during a process of realizing that things aren't going the way they would like to, and that in all likelihood it's not going to be a good financial outcome?
Yeah, from our perspective, in most cases, these conversations have started happening way before we're having tactical step-by-step conversations of who do we pay, who do we delay, like who do we negotiate, and all of that, right? And all of the legal and admin around the wind down. Our expectation is always that, after we write the check, we level set with the founders and we're like, great, we need to make sure that we're doing everything we can to continue to build trust here so that we can find out about problems when they are still solvable. So for us, I would say, for everything leading up to this moment of a potential wind down, we want to have clear, regular communication. We want to make sure that we don't have founders going dark for weeks, in some cases, months on end. And this is a bit of a personality thing, right? Some founders are really good at asking for help when they need it. Others tend to sort of spiral and go dark. And part of the onus is on us to make sure that we are communicating to them effectively and making sure that we're making ourselves available and being proactive around getting ahead of some of these potential issues. But I think we also just really want to have those conversations up front, right? And in some cases, within 3 to 6 months post-investment, right, far before the company has started to really run down that cash balance, we'll start to see whether things are on track or whether there are issues that are outside what we had initially expected, if there have been major strategic differences, if the pivot that they said they were going to do is now going terribly, right? Some of this starts to come out pretty early on. So we try to get ahead of that in those conversations initially and kind of talk about like the inevitable potential death before it's close so that you can take some of the fear out of it, right? When you can kind of say, all right, worst case scenario here is this. We can talk about it very clearly. We generally have a sense then of like how much time would we need if we got to that point. When we're investing at pre-seed and seed, there's usually not a ton of business complexity that takes a ton of time. So we usually have a sense then of, what's the point at which we would have to start this process if it came to it. And then in terms of just managing, investor expectations throughout this, I think it's communicating on a regular basis. It's being transparent about the challenges. And it's also having enough communication around what you've actually already tried and what you've done. I think this is one of the more challenging things to balance from the investor's perspective. I never want to be micromanaging, right? I am not the person who knows the 82 things you've done. I don't want to be the person like thinking or saying like, have you thought about this? Because obviously they have. So the more that we can sort of bridge that context gap, the easier it becomes to have some of these more tangible conversations. And so from my perspective, look, if the founders have been transparent about, what they set out to do, they've been transparent about the challenges, they've clearly communicated what they've tried, what the possible scenarios are, and we've all been on the same page throughout that. And there's no bad blood at the end of this. We understand that part of the purpose of venture capital is not just to accelerate growth when things are working, it's also to actually test if there is a viable business here. And sometimes the answer to that question is no. And that's a perfectly fine outcome if that's where we ultimately end up.
Gray, maybe there's some self-selection, because the folks who are coming to Sunset are obviously trying to do this in an orderly way. So maybe you're getting the better half of founders sort of coming to you, but I am curious as to like in what percentage of situations where a founder approaches you guys and says, hey, I think we have to go through this process. Is there complexity like, oh, by the way, the investors don't know this yet, or there's, things that need to be settled before you can go through this, or there's going to be surprises or whatever. Is it a lot of those situations, or?
I would say almost always, and whether or not it's known to the founder up front versus halfway through our conversation after we do discovery and ask them about certain, aspects of their business, it usually comes out that there is something that needs to be done beyond which the founder expected. I would say it's a mixed bag with regards to how informed investors are or the cap table is about the current state of affairs and the likelihood of them having to wind down. Usually what we often see, and Geri, I'm actually curious to hear your perspectives on this, is founders will express that a subset of the cap table or a core group of their investors knows, but not everybody does, which I imagine is just a function of how relationships evolve with, investors over time, right? You just grow closer to some and not others, or look at some as trusted advisors and not others. So I would say increasingly we see a lot of cases where a founder is operating in a bit of a black box beyond the perspectives of their own employees, beyond the perspectives of their investors. And in those situations, a lot of what we just discussed about sort of the best practices for what to do if this is the likely outcome are the things that we encourage, right? Which is proactive communication and transparency especially with investors, proper consideration being given to employees. We offer free consultation calls with our employment lawyers on, the law firm that we partner with for the solutions. And of course, if there is enough runway and sort of cash in the bank, we definitely recommend that they continue to work with their existing counsel, considering all the context that they have on things like that. But yeah, I hope that answers the question directly. But
I am curious as to like the things that pop up that founders didn't realize, and just generally the biggest areas that founders underestimate of this process, that they are surprised by, either the complexity or costs that they don't realize or legal. And what's the sort of top few things that pop up that are surprising to folks or unexpected?
yeah, I would say, a big complexity or surprise to a lot of founders will be in cases where a company has outstanding trade debt, accounts payable, liabilities, obligations, and they anticipate that it would take, a week to kind of go to all of those different creditors and negotiate with them and negotiate releases. And based on the data set that we have compiled over the years and how many companies we've helped through that process, it tends to be a lot more involved, a lot more complex, and the timelines tend to drag out. So I just think it takes a lot longer than they expect. And the outcomes aren't always as clear, right? Another huge one is just general tax compliance, right? If they've had employees in a bunch of different states and they have been, I don't know, maybe selling a physical product and they have sales tax obligations in a bunch of different states, like they need to make sure that those are met and factored into the remaining cash on hand. And, maybe the last one would be serious consideration for their non-cash assets and IP, right? So if the company has developed something that potentially has market value, founders technically, as I believe, and Heather, you can jump in and correct me if I'm wrong here, not a lawyer by trade, but they have a fiduciary responsibility to maximize the potential value of those assets. And, at some point, potentially explore sales or, something to that effect if they have the ability to do so. A lot of the founders will say, hey, we're going to shut the company down and I'm just going to assign all the assets and, all the code bases and IP and products over to myself, customer contracts and the like. And while that can sometimes be a totally appropriate path to take, there are other steps that need to be taken before then. And so, yeah, that tends to be something that creates a lot of complication, and founders don't always.
I have to add a couple of things. I think that the wage and hour stuff I mentioned before, like PTO, commissions that are earned and due, those are items that folks think, oh, well, I've got next payroll or next bill, which is really important. Thank you for paying attention to your payroll. That's what every investor and lawyer wants you to be doing. But it gets a little bit more complex than that. And so you really want to make sure you thought through that with your payroll company, co-employer, counsel, accountant, anyone. Just try to get an accurate calculation, because again, there is personal liability there that exceeds just you as the founder potentially. And we don't want it to go to you anyhow if we can avoid it.
And Heather, one of the complexities around that, just to add in, is like people might think, oh, I'll go look at the payroll I've run,
Exactly.
which is, people's base salaries, but like JustWorks or whatever other system you have may not have the calculation of commissions and sales
Exactly.
bonuses and all of that sort of stuff, which
Your PTO policy might not be aligned with it or updated, things like that. And it's not like the employees are bad actors. Like, just like if you're working for like Pepsi, like this is what's owed and you would expect it to be owed, and the state is going to make sure they get paid. Another place where I think that there's a big gap is even if an investor, like a fund, is not able to put more cash in because that's, their fund decision, it doesn't mean they're not interested in helping. And so I think sometimes there is a gap there, and not everybody's as proactive necessarily as Geri and Charlie are with their companies. Don't assume that they don't want to help, and definitely don't assume they don't want to be communicated with. I know sometimes that's the feeling, and I think sometimes that creates some of the distance. So just don't make that assumption. It's still their investment, and they should at least be updated, but might actually help. I think the biggest, in addition to the wage and hour, the biggest surprise that I see often is timing. Folks can get way too down with the wire, whether it's on communications, whether it's on seeking alternatives, whether it's about, documenting all the stuff you've done. And the closer you get to the end of the line and cash out, the less options sometimes you have. So getting a handle on things earlier, even if it's calling it quits, can still maximize value in some ways better. It's very hard to sell your company. If somebody's not willing to write a check to for your company for more investment, it's very hard to sell your company. There are a lot of costs associated with it. Those are really, truly Hail Marys in terms of actually getting it done. But that doesn't mean you don't have assets to be sold, liabilities to be paid, and a process to go through. Just sooner can be better, and delaying does not necessarily and usually doesn't maximize value.
Geri, I want to ask about the time spent because, Heather makes a great point that just because somebody isn't willing to write a check, doesn't mean they don't want to be helpful. But you only have so many hours in the day. And if I were an LP in your fund, I would want you maximizing outcomes, which means making sure that your winners return the whole fund, maybe not spending as much time with the companies that, like, no matter how much you're helpful, okay, maybe I can get 5 cents back on the dollar versus 0 cents back on the dollar. There's a friction point there, right? And do you have to draw limits, or should investors draw limits on how much time they can spend in those situations where the outcome is not likely a good one? And how do you manage that personally?
Yeah, this has been one of the biggest learnings over the last year or two for me personally, because I guess I underestimated the extent to which what you're describing is true. Like, we've just had cases where we are, one of the earlier, smaller investors. At some point, you pass the baton to the later stage people, and you sort of assume they're the new adult in the room when it comes to a lot of this. And we've had, just again, hindsight is 2020, but you would think when someone's put $10-20 million into a company that they are going to kind of be on top of this. And with the way venture's gone these days, even in a lot of those cases, that level of interest is not quite there. So the learning for me, right, because our portfolio construction is heavily front loaded, we actually care if every company lives or dies or reaches the best possible outcome. Like, my learning has been in the other direction, which is we actually need to stay more involved for longer than we might have initially expected. And I think in terms of like what actually makes the difference on outcome and what's the best use of our time, the way I think about that is there's sort of a critical period where we may actually be able to materially change an outcome. And that is not in the last 2 months, right, before they run out of cash. You have to spend the time and do that work earlier on so that you actually have, to Heather's point, some options on the table. Because once you get to that point, then it's just kind of blocking and tackling and what's the fastest, easiest, cleanest way to actually get to the outcome. There is no, there's no alpha to be generated there. That is just, incremental. So the way we think about it is we just have to be, as involved as possible and as reasonable in those interim stages. And once we start to see 6-9 months out before the cash out date, that, this is what it's looking like in terms of future funding. This is what it's looking like in terms of revenue generation. This is what the options might be on acquisition, that we are really making the right choices at that point so that you have enough time to see that process through. And again, like our learning just as early stage investors has been that we still have to be involved in that if we actually really want to materially impact that outcome. And then, if you get to the point where there is no path forward, it is a wind down, hopefully you have enough foresight into that where you have enough time and enough cash left to bring in the right partners who are going to be logistically handling this. We are not the right people to be dealing with tax obligations and vendor negotiations and whatever it might be. But we can hopefully set the company up with enough time to be able to bring in the right people who will support them through that stage of the process.
One of the things that, in terms of those critical points, I remember one company I could sort of think of coming off of the sort of 2022 tech decline, and folks were thinking about their plans and doing budgets and cuts and whatever, is that I sort of reminded some of the investors around the table that like growth oriented companies and companies that are growing are the ones that get the next round. And unless like cutting to moderate growth sort of just delays the inevitable, right? So I think when I would think about my portfolio, I sort of really bucket, folks where we should lean into strategies that are winning, and then everybody else, and in the everybody else category, you have to seriously think about, should we cut our team down to bare bones level and pivot? Because if you're in a strategy that is like barely growing or flat revenues, but it's not zero, that company's not going to get its next round of funding, right? 2% growth a month at a post-money valuation of 50, right? With 10 million into the company already. And we're at, I don't know, call it $1.5 million of revenue. Like no one's funding that company the next time around. Right. And so you're sitting around that table with a team of 20 at that point or whatever. Like if you're not leaning hard into growth, people should be having serious conversations about like, should we sell the company right now, even though there's 18 months of runway left? Or should we be testing out some new strategy, pivoting into some, other kind of product while we actually still have runway left? And I think too often is this like slow path to decline where, like you said, later stage investors, they're showing up to the meetings, but they're kind of partially checked out. They're not ringing alarm bells, and like nothing's changing in this company as it sort of slowly marches towards the end. And I think that is the sort of critical period where someone could raise their hand and say like, what are we doing?
Yeah, I think the key point there is your comment around nothing is changing. Because we've had companies in our portfolio where they've sort of been stuck on something, right? Like they're not growing, they're closing some customers, they have some churn, but they're able to actually diagnose what the problem is and are able to quickly iterate around it and get out of that slump. That obviously, it depends how much time they have, it depends how much capital they've already raised. But we've had companies that have gone through this period where it wasn't clear if they'd be able to raise more money and what path forward would be. And then they have gone from $1 million, $1.5 million to $3 million to $6 million, on track to double again year over year. And so there are cases where it's possible to sort of find your way, and you can have a really successful outcome on a capital efficient basis, even if you don't necessarily have the metrics that will be required to raise additional capital. But to your point, I think all those conversations have to be had pretty transparently and pretty early on when you still have time to actually make choices. Because if the path is going to be, listen, we're probably not going to raise more money anytime soon, we're going to grow this business profitably, you have a lot more paths to get there if you have 8 months of cash in the bank when you make that decision versus 3. By the time you have 3, there's nothing to cut, there's no way to extend, there's not a lot of wiggle room there. But I do think that there are a lot of cases where you can still have reasonably successful outcomes within the venture world and definitely successful outcomes for founders, as long as you can make that call relatively early on in the journey.
So Gray and also Heather, I want to talk for a moment around whose responsibility is what. And to some extent, Heather, it's like a similar question that I asked Geri. As a law firm, you guys make money mostly in a successful company, right? You ultimately want to to be the counsel when they raise the A, the B, the $200 million F, the IPO, all of that sort of stuff. You're not making a ton of money off of, seed funded companies or companies that sort of don't really make it, right? So, and, we all know that, most of the, sort of brand name law firms, very generously get the short end of the stick in this process sometimes, where you're spending more time than you ultimately get paid for. I'm not advocating that in any way, but we just sort of know it happens. And so when a founder thinks about, okay, I have to go through this process, how do you balance, like, realistically, what should I count on from my legal counsel? And then, from the sunset perspective, like, what are you guys doing and how can you work together in this process? Like, who's ultimately, I guess to some extent, like, the founder feels like they should be project managing this, but they don't often know who to delineate, who's taking the lead on this. So
Sure.
maybe Heather, you can just sort of start off.
I mean, I think two things. One, I always say, like, part of being a friend is being a friend when, like, your friend's not all there and doing great. And, like, part of that is being a lawyer. Now, technically, do I have to do it? No, but I think it does differentiate, like, the folks who in the firms who really, kind of support founders and the funds, including the early funds who are there all the way through supporting the founders, like, who's around when you're, like, going through a bad time. So can I do everything? No. Is it practical for us to do everything? No, we're not set up like that. We're set up to scale, and our prices are justified by us being, like, wealth maximizers and, like, figuring out how to, like, help you commercialize things you might not be able to commercialize, navigate regulatory regimes, all sorts of things to build. We do have financial restructuring practice for larger clients. And if you are in a position where you're considering other alternatives, whether it's bankruptcy or ABC or state dissolution on different levels, and you may want to talk to a specialist. But when it comes to the actual, you've decided to do a managed wind down, like, we're too expensive. Your accountants definitely need to be involved on some level. They have the history and can work with folks like Gray and Sunset. But really, like, this is a huge benefit to everybody involved. The lawyers, the investors, in terms of, like, the time, like, we can be in and we can be, like, not reaping back our time. And, like, that's just kind of being, like, working with founders and what you sign up for as an investor or a lawyer. But at some point, it needs to be handed off. And there's, as Greg can tell you, like, many, many steps in the process. And it's like peeling back an onion. Like, it keeps coming. You don't know what's next. And so that's something where there's a really great efficiency to work with folks who really specialize on managed wind downs. And they are the right people to maximize the assets. And it's such a better alternative than, I'm going to sell my company. No, you have $25,000 in the bank. You have all these things to do. And, like, the acquirer knows that. And, like, again, it's a Hail Mary. I've seen those deals work out, but it's extremely, extremely rare.
I would double click on that last point. Something that we really commonly see when we're in an ideal state, we're meeting founders, kind of to Geri's point, at that 12 to 9 months to cash zero point, largely approaching the conversation from a scenario planning standpoint. Post that conversation, many founders go on to explore alternatives to raising additional capital, including trying to sell the company. And many times they'll get involved in a sale and a process where, Heather, to your point, the acquirer is more or less fully aware of the situation. And I won't claim bad acting. Sometimes it's probably just shrewd, business decisions. But
and they have fiduciary obligations too, is what I try to remind them. They're not necessarily bad actors. It's like they have to get the best price too, which they see dropping every day on your company when it's at the end.
Yeah. And I literally just spoke to a founder yesterday who was planning on getting signed up with us about a month ago, had told us that, they were sort of down to the final stages of negotiating an APA with an acquirer. He went dark for a couple of weeks. I got the sense maybe the deal had gone off the rails. And of course, we spoke yesterday and he had said, basically there was a term that they couldn't get past and the deal had been blown up. And now the company is they have $20,000 in the bank, a couple $100,000 in, associated trade debt that they're now going to have to navigate. And so it just puts them in a really tough spot. But Charlie, to kind of go back to your initial question here, and actually maybe to Heather's point as well, Goodwin and the likes are incredible for value-added services. And at the end of the day, dissolutions and managed wind downs are not rocket science. They are tedious. They are more complex than meets the eye, but it's unlikely to be something that really justifies having a lawyer like Heather and their team really directly support, right? Both that and it's probably uneconomical to do so based on billable hours. And, the other point too, Charlie, that you had referenced is a lot of founders do whether it be ego driven or have, based on hubris, like will decide that they're going to project manage a wind down on their own. And a talk track I commonly kind of use is like, you should not have to upskill to do all of this, to learn all of the nitty gritty individual steps. Because candidly, if you're to make one or two missteps, you're talking about extended timelines and, increased costs. And so what Sunset really aims to do is centralize everything. We offer direct legal services through a partnered law firm out in San Francisco. They're incredible. They're boutique. They are not Goodwin, and we will never claim them to be, but they're, very competent and experts in dissolution, especially. We have tax teams in-house and have really clean processes for taking over prior, basically accounting and bookkeeping from prior firms. And the benefit that we offer is, again, we are not KPMG. This is not the greatest tax services in the entire world, but it is absolutely sufficient for what they need. And so there's some cost savings that we can pass along there. And then lastly, we offer kind of integrated project management, have built a ton of internal tech as well as external tech, client facing, to help everybody stay informed and in the loop, communicate more proactively with all the right stakeholders. But yeah, it is we say any dissolution takes anywhere from 80 to 160 steps to execute. No two are alike. Heather, the analogy was perfect. It is very much peeling back an onion. You do one thing and find out there's three other things that need to get done. How you prioritize those three, how you execute on those three makes all the world of difference in terms of the efficiency of the wind down. So that's what our project managers are there for. That's what our teams are there for. And this is just not something that a founder or a law firm should have to do directly.
Great. I was a little surprised to hear you say that you would talk to companies like with 9 to 12 months of cash left in the bank, because I think if you just took a cutaway view of every company with 9 to 12 months of cash, that's basically most companies, or at least like companies wish they had 9 to 12 months of cash left in the bank. And so at that point, it's not clear that the outcome is going to be negative. So I'm actually just curious, like if I came to you with that, like what would we even talk about? Because I might not, I still might have some opportunities left to create value here.
Absolutely. So a lot of what we'll do is just scenario plan around that is a potential dissolution, if that is a potential path for them, right? Get them familiar with what the process looks like. Get them better understand all of the permutations of wind down. As a Heather reference, managed wind down is just one potential solution. There are alternatives like ABCs, bankruptcies. So depending on the situation of the company, even with a 9 to 12 months of cash runway, it might be that one of these, based on the way they finance their company or based on their overall debt obligations, it might be that one of these is a more appropriate solution for them to consider if it ends up coming to it. So we will proactively connect them with groups, really make sure that they understand all their potential options. And then something else, we've had a lot of conversations with VCs over the year, a lot of conversations with law firms over the years. We have a general sense of what the best practices are for companies with that amount of runway, that amount of timeline, that much time. And we'll do a lot to encourage them to kind of take advantage of the other options that are available to them, be it communicating and connecting with your investors and exploring potential sales. If they've pulled together a really cracked team, as the kids like to say these days, potentially an acqui-hire is something that they could explore if, again, they're not seeing the growth on the product side and the revenue traction they need. But it's destigmatizing potential wind downs by way of like helping them understand what it actually looks like and what it'll actually cost, and also encouraging them to go try and do things to avoid this outcome. And as ironic as it sounds, I'm one part consultant, one part salesman here for Sunset. We very much hope that founders don't end up working with us. So a lot of the conversations that we have at that time is under the framework of like, hey, let's help you scenario plan. Let's make sure you're aware of what this path looks like, but then like forget about it and go focus on trying to do anything to avoid having to work with us here. And it's very much how we operate. It's core to our DNA. It's core to how we built out our network. So if we can ever be helpful, we will attempt to do so.
So I want to get to some of the questions that are asked. So feel free to ask questions in the chat. But Geri, I want to ask you, other than months of runway, what are the sort of signals that increase the chance of going out of business? Because listen, I can cut my team down to very small and have 24 months of runway, but there's a set of circumstances that might give me 100% chance of failure, even though I have a long runway, right? So runway is not the only predictor that things aren't going well. So when you are sitting next to a founder and you're getting the sense things aren't going well, they're not seeing it. What are some of the other indications that like, yeah, maybe we should have these types of conversations?
Yeah, there's sort of just this inevitable feeling of treading water. Like you show up to the meetings, whether it's a board meeting or just a catch-up call with the founder, and you're kind of having the same conversation every time. That to us is always a flag of like, all right, whatever problem we had a month ago, we still have the same problem. We're not making traction on solving this problem. We're not pivoting to something else. I think that is sort of like an inevitable feeling that you get that there's a problem. And I say this from the perspective of most safe companies that already have a product in market, have some customers. We generally, with our strategy, are not taking on a ton of pure technical risk. So I'm setting aside the fact that like you raise money to build a product and the product doesn't work, right? That would be one scenario. But assuming the product like roughly works and it's what you thought it would be, we're often really looking at what's going on in the go-to-market motion and in the sales funnel. So are we seeing that your sales cycles are not getting shorter, let alone getting longer? Sometimes that happens. Are we seeing that, whatever sort of go-to-market motion you had with this enterprise champion, that this person is just not budging and there's no sign on how you're actually going to be able to crack this nut? You might still have a lot of time. You might have even some revenue expansion within your existing customer base. But if you're not able to prove out the specific strategy that you thought was going to unlock growth, that again is a concern. So we are often looking at kind of those core sales and marketing indicators to see if things are moving in the right direction. And then it shows up in the financials eventually, right? Like that, if there's no growth, inevitably you will have some churn that will start to turn all your graphs down into the right instead of up into the right. And we start to see that. But again, I would say the main thing is like, if we're just not making progress on validating the core assumptions that we set out to prove with this particular round of funding, and we're kind of stuck in Groundhog Day, it usually means that we need to either pursue a significant strategic pivot or we need to think about what the path forward might actually look like.
What you were saying, and one of the Aaron's question in the chat, what if investors and shareholder majority believe a shutdown is necessary, but a co-founder believes the door should stay open? It reminds me of a company that I was working with, and I had another investor around the table with me where it was a consumer company that like literally had no users. And when I say no users, I mean 0 users. And the founder was sort of caught up in product development and always thought that they were a feature away from going viral. And every monthly check-in was sort of the same, right? And on one side, we were sort of reading the tea leaves. On the other side, he was in a reality distortion field. And at some point, it was actually an interesting strategy. The investor said, I see you have a plan here for product development. You let me know, at what point should enough features have been built where you feel like things should start to turn around, right? And so this question of, whether the co-founder believes that things should stay open, I think one place of agreement that everybody can get to is there should be some point at which some set of KPIs should turn if the founder is right. Right? The founder can say, well, I'm doing this, or I'm seeing this thing, or whatever, and say, okay, you tell me at what point you would start to worry. If you don't have $1 million of revenue by X date or whatever, and at that point, so as an investor, you can kind of claim some time back. So, okay, well, I'll check in with you in January then. If you're telling me you'd be stunned and ready to come to the table to negotiate a wind down process or whatever, if you don't get $1 million of revenue by January, cool. See you in January. Like I just got 3 meetings back from my time, and then everybody should be able to come to the table on the same page, right? This is the metric you gave me. I didn't push this on you. And when that happened, that really changed the nature of the conversation, right? Because I'm just reflecting back what you told me the KPI was going to be.
Yeah, I think that honesty, right? It's a super hard conversation to have, but I think you're spot on. And I think one of the ways to handle that is just to say, hey, here's what we are seeing. Here's what we feel is the problem. Here's what our concern is. And founders, to your point about distortion fields, right? They have to be endlessly optimistic, right? But we have to sort of play it out to them and then say, okay, clearly you see something different. We are not seeing what you are seeing. We are assuming that you are a visionary. This is why we funded you, because we believe that you are ahead of the market and you see something that most other people don't see. Tell us at what point, exact same strategy, Charlie, right? Like, what do we actually have to prove out for us to regain confidence that there is a path forward here? With the caveat that you have to be careful not to make the measure the objective. Because if you say X in revenue or Y in users, and what the founder does is then like come hell or high water, just brute forces their way to that, if that's not actually the problem you had, right? If the problem you had was like, there's no scalable go-to-market strategy here, we need to prove there's a scalable go-to-market strategy. And we can agree that if you could get to roughly these numbers, maybe there's something there. If they circumvent the actual objective and get to the metrics another way, then you're stuck in the loop having this conversation again. So I think it's really tricky to balance the transparency without discouraging the founder, and also while being really, really explicit about what the actual concern or objection is.
So, Gray, you talked a little bit about sales, and I do want to point out that we are going to do a follow-up webinar about a sale process and trying to do some selling. But I know you talked about asset sales, and I wonder if you could just sort of touch upon some of the ways that, without buying the whole thing or, a large scale sales, some of the maybe lower hanging fruit ways that you guys might be able to help companies with, at least creating some value or what is actually valuable people might not think of.
Yeah, it's a great question. There are a set of non-cash assets that are, I think probably everybody assumes would have some amount of value, although sometimes there's a perception of it having more value than it really does. Of course, equipment, office furniture, things of the like. A lot of people will assume, hey, I bought this computer for $2,000. I can go back and sell it on the market for $1,500 since it's used. That is just not the reality of how, the secondary markets work for those types of products. That in general, if a company has amassed a significant closet of IT equipment and things of the like, Sunset knows of a bunch of really, really wonderful liquidators that we're able to connect them to. It's far less efficient for us to take on that work, but we sort of outsource it to third parties. The same thing goes for companies in either regulated industries or with tech that involves a lot of trademarks and patents. Patent portfolios are often more valuable than folks will assume. It's a little bit of a toss-up. I mean, it depends on what the patents are, but we also know of incredible patent brokerages that we can connect folks to, both for like a consultation and an assessment. So maybe that's something that we do at that 6 to 9 month mark, is go say, hey, go speak to these partners over here. They'll give you a sense of what, the potential market value is for what you guys have on hand. And then again, with enough runway and time, founders can often pursue that path.
The licensing thing is something that I've had come up in my portfolio, where someone spent a year going through various regulatory hurdles to get a particular kind of fintech related license. Ultimately, the asset that they were trying to trade regulatory things didn't fall in their favor. But they found somebody who was willing to buy that license to shortcut a year getting into the market. And just to have that entity, because that entity had been granted some kind of, regulatory approval that they could sort of merge their way into. So sometimes you're just saving people time, even if they're not going to use the asset, right? They can get it themselves, but it's going to cost them also $1 million to get there. So, maybe you can get $250,000 back for that. One last take about managing this from a, kind of time and effort perspective. And Geri, I'm going to share something, and I'd love to get your comment on it. I recently had a founder sort of, start a wind down process, and it was a little surprising to me. And one of the things they had mentioned is that they clearly were fundraising sort of earlier in the year, and that didn't really work out, and that investors around the table weren't as helpful as they wanted to be. And, when you have a board seat, you clearly have been, it's like a deal with the founder that you're on the hook for being a little more helpful than everybody else. But one of the things with this company is that there were no investor board members. And so you had a lot of people on the cap table, but no one in particular felt that important. So I guess we all saw that message, but I just assumed somebody else would be looking at it, or somebody was looking at it, and sort of, it's like a sort of all the outfielders and the ball drops in the middle, especially in those situations where you think the later stage folks are going to handle it. How can founders sort of get more engagement from their investor base when they have a lot of people on the cap table? And because there are some people who might have 30 odd people on the cap table, and if everyone was very motivated to be helpful, we'd get some stuff done, but that rarely happens.
Yeah, I do think the onus in those cases, and this probably sounds a little bit unfair, because founders have so much that they need to do. But the onus is really on them to structure this process and run it the same way that we encourage them to run a competitive fundraising process, right? You have your tracker of funds you want to meet, partners you want to meet, who can introduce you, how are we going to do this, divide, conquer. You kind of have a scoreboard right on that Google sheet of like who actually made any of these intros. I wish we saw that in a more streamlined way more often when it came to some of these potential M&A processes, even in cases where there's sort of like a clear front runner and it looks like they're going to be acquired by this one company. I think there's just so much execution risk there and you risk losing leverage too early on in that process. And so my like encouragement there would be, especially in cases where you don't have someone who's clearly responsible, but even when you do, right, you want all the help you can get, make sure that you have a mechanism for structuring that. And if you don't have the bandwidth as a founder to take the lead on that, either rope in your co-founder to do it or sort of the closest lead investor, whoever it might be, to help you quarterback that process. Because I think that's the only way to really make significant traction there and to continue to really transparently communicate with everyone on what the plan is and what's going on there. Charlie, I think your point is like total tragedy of the commons. Everyone assumes someone else is doing it if they're not being like personally roped into it. I've had surprises like that where I'm like, what do you mean you haven't talked to this company yet? How has no one introduced you to this company yet? Like, why am I the person who's now like doing this? This intro should have been made like 3 months ago. And I think, it's just a reminder for us as investors to make sure that sometimes we're asking the questions that feel stupid, right? They feel too obvious to ask. And for the founders to really just be like super explicit about what kind of help it is that they really need.
And individual calls. I can't, oh, I put it in the last update email. Yeah, that was like 2 pages long. And, I asked my way on as a board observer 2 years ago. You said no. So admittedly, I don't read every email now. Like I wanted to be in all the meetings, right? But if any founder in my portfolio was like, hey, I need a half an hour with you tomorrow to just walk through, like, here's my list. Do you recognize anybody? Here's our plan. What's your feedback on this? Like, you'll get more engagement if you just dedicate time to getting everybody live on the phone than mass emailing everybody and assume everyone's going to make time for that email.
Yes, completely.
Cool. Well,
Really sorry. I have to jump. I have
yeah,
another.
no, it's just we're going to wrap up. But thank you so much, everyone, for their
Thank you.
time. Gray and Sunset, thank you for supporting our events. What's the best way to get in touch?
You can find us at sunsethq.com. My email is gray@sunsethq. If any founders, any investors, any law firms ever want to learn more, please feel free to reach out.
Cool. And thanks, Heather, for joining us. Really appreciate your
pleasure.
time, and Geri as well. Thanks,
Thank
everyone.
you all.
Thank you, guys.
Bye-bye.
Bye.